Joining us right now is Alpine Funds Portfolio Manager Sarah Hunt. And Sarah, the race for these streaming supremacy is certainly heating up. I know you own technology. Do you also own Netflix and some of the streaming in media, or Disney?
So we're dividend players. So a lot of those companies are not paying dividends right now. So we would own something like an Apple, which does pay a dividend, and a Microsoft, but we wouldn't own something like a Netflix here. And I think that this just shows you also the tension between, is it the content, who is going to be in charge of what's going to happen? And I think that this was a big, when I saw these numbers last night and when I saw the announcement from Disney, I thought this is going to be interesting because Netflix is one of those companies that's held up very well. So let's see how that goes on the back of this and whether or not other people think about following suit.
What about the broader markets? What do you think?
I think we're in a period where we've had some really nice earnings for Q2, right? This first half of this year has been really good relative to the last couple of years where you had fairly stagnant earnings. So I think that's been very supportive. But I also think that the market is expecting a lot of things to happen on the political front. And the question of whether or not they're going to happen becomes one that becomes more and more important as we get through the balance of this year. I also think as we get into the second half of the year, let's see what people start saying about next year. And I think that there is some concern that the valuations are at a pretty high level, and so therefore you either have to see continued growth or some changes on the other economic fronts.
I agree with you on the growth front, that we need growth to keep prices where they are, but I would kind of disagree on the political front. I think where we are right now, the market is supported up here at these levels by the earnings growth we've seen. I think if you get something out of Washington, it would actually be a next leg higher in the market, because I don't really see it being priced in here. I think the numbers can support it. But then when you see a company like Disney that misses on numbers, the market's going to punish that stock, and that's what you're seeing this morning.
We've also seen less, there was an interesting report out yesterday that talked a lot about how companies are reacting to positive surprises and that they're not reacting as well to positive surprises as they have in the last couple of years. And that might also tell you that there's a little bit of a push to what do I get to that next increment. So maybe that's that, but I also think that people started to build in some numbers into 18 on tax reform that may have to come out. We'll see how that goes.
Yeah. Sure.
If you're looking, though, if you think this market is overvalued or a lot of the really popular stocks are overvalued and you're looking for ballast, you're looking for something to offset the risk in your equity portfolio, can you really put money in treasuries at this point? If you look at the yield on the 10-year treasury, it's below 2.3%. Those are also rich. And theoretically, if you had both markets go the wrong way on you, that's all she wrote.
Yes, and you probably have more risk in treasuries if they go against you because the change in interest rate, because the rates are so low now, right, is probably more problematic on price. I think that a lot of the stocks underneath the big tech names and some of the big stocks and the averages have actually gotten, you've seen a lot of stocks actually come down in the last 6 months on the retail side, on energy. There have been some places where there is room. Now, there's also some threats there, which is why those stocks have gotten cheaper. But I think there are places to look. And the defense stocks, while they're expensive, if you look at what's going on right now, I think that there's some places there that you can look. And it's the same problem that everyone's had for the last couple of years, is where do you put your money when you've driven interest rates low across not only the U.S., but international. I mean, it's even worse. You've got negative rates across parts of Europe. So that's even harder for people looking to put money to work.
Sarah, let me just ask this. If Congress were to actually get tax reform done, does that supercharge the market in all the sectors? Does that really make that kind of difference?
That's what you think.
I think for sure it does, Governor. If I could just weigh in on that. Yeah. Because that gives all companies a tax break, gives more companies increased earnings. Just balance sheets will look better from that. Now, you've seen in this market, the reason we're at all-time highs is that you're seeing rotations. When people sell energy or they sell retail, they're putting that money in large cap tech, or they're putting that money in the financials, in the banks. So I think money would come off the sidelines. New money would come into the market if that were to happen. I think that would push the market higher.
I think it would definitely help. I mean, there's a lot of companies that have a lot of sales overseas. So the companies that would benefit the most are the ones that are primarily U.S.-based, because that's where their taxes are going to get better the most. If you could bring some of the money back from overseas, I think there's a lot of cash trapped over there. There's been a lot of discussions about that back and forth, about whether or not, how to bring that back and what do you do with it, and do you put parameters around what you do with it? Because I think that we're still looking for capital spending, and that's still been a subpar version of the kind of growth that we're looking for on the economic front that's absent what the government can do. So if you could bring some of that money back or free up more money from a tax perspective, maybe that's something that starts to kickstart other parts of the economy.
Business has been sitting on cash because of the regulatory environment largely. But let me ask you about North Korea. How much of a focus is this for the markets? I mean, yesterday it felt like the market did react. Was that what it was reacting to yesterday, in your view?
It felt like it was reacting, but it was still a fairly moderate reaction.
Yeah.
I mean, even the Kospi, which you would think of all the places where you would see an outsized, you're not seeing that much.
What kind of a wild card does this represent for markets?
I think the market has seen so many different wild cards in the last year or two that it needs to see something that feels more like other than rhetoric for it to be more of an impact. But I also think you're getting out of earnings season. So from a catalyst standpoint, you've taken that off the table. So it may be that August, which can be a tough month anyway from a volume perspective, is trickier to react to things because you've got less trading going on, and so therefore you might see a bigger reaction. But so far, I wouldn't say that this is a huge reaction thus far.
If you want safety in your portfolio, I raised the issue of 10-year treasuries, want a little bit of security, less risk, what do you buy at this point? Because you have vast numbers of asset classes that look expensive. Not wildly overvalued.
So we're long-only stock mutual funds that basically run dividends. So we would look for higher dividend stocks in places where you may have seen some corrections already. You know, on BP, something like that. But I agree with you. I think it's very difficult, and I think that that's part of the problem. And if you look at credit spreads, they've gotten incredibly tight, which is telling you, you know, high yield has been chased down both in the U.S. and in Europe. And in Europe, it's even worse, the high yield spread over governments, because governments in some cases are almost nothing, negligible or negative. So I think that it is a really challenging period of time. And to be putting together a portfolio, if you're an insurance company or somebody else who's trying to then work out pensions later, is a very big challenge in this environment.
Did you get a sense of the rest of the year from what you just heard out of the second quarter earnings reports? Second quarter profits up 11% or so, revenue up 6% or so. What about the rest of the year? Did you get a sense of their guidance?
I would say that it was pretty positive, although what was interesting is that a lot of people who had beats in the second quarter didn't want to raise full year guidance, right? So that's telling you that maybe the back half of the year isn't as strong, or they'd just rather be cautious and let themselves be in a position where they can beat earnings again. Because what also happens...
And they want to see what's going to come out of Washington.
Yeah. Right. And what also happens is that the analysts take numbers down in the middle of the quarter for next quarter, and then they end up coming back up in the middle. So there's a lot of gaming that goes on in that respect. But I would say that I didn't hear a lot of very cautionary second half statements. I heard more, you know, we're doing pretty well and we're pretty optimistic about the next few months.
And the executives are talking less about President Trump on at least early analysis of all the conference calls. You just heard less discussion about Washington and about President Trump. So they're sticking to their knitting, so to speak.
Which is a good thing.
Right, exactly.
That's what you want. $4 billion in assets under management. Are you fully invested?
We are.
Great. Sarah, great to see you.
Thank you.
Thanks so much for joining us this morning. Sarah Hunt there. Coming up.